This brings me back to the man himself and the sheer weight of his prognosis. Eric Sprott is not an academic. He is a miner and a financier who understands the value of assets that exist outside the liability column of a central bank's balance sheet. He knows that when trust in the credit system evaporates, when the sovereign debt of major nations begins to look unserviceable, investors rush towards tangible, finite assets. And this is the great revelation he is preparing us for. The 2026 recession will change everything because it will necessitate a complete monetary regime shift. The system will crack under the weight of its own interest payments. The political response will not be austerity. It will be debasement. They will try to inflate away the debt, destroying the value of dollar-denominated savings, bonds, and fixed income assets. That moment, when the market recognizes that the debt is not just large but fundamentally unpayable, that is the climax. That is the point where fiat currency loses credibility on a global scale. This will not be a slow leak. It will be a rapid, violent repricing of value. The closed loop, the solution Sprott is already aggressively implementing in his own portfolio, is clear. There must be an exodus from paper promises and into real assets, specifically precious metals, especially gold and silver, which serve as the ultimate insurance policy against currency failure and systemic counterparty risk. The physical scarcity of these assets versus the infinitely expanding supply of currency makes them the only true sanctuary. The economic transition we face is therefore not a soft landing or a hard landing. It is a forced monetary reset driven by the mathematical certainty of sovereign insolvency. This change is not coming in the distant future. The fuse has been lit, and the timing of the detonation is tied directly to the 2026 debt maturity cycle. The opportunity now is to position yourself before the crowd panics, before the majority realizes that the stability they once relied upon has dissolved into vapor. This transition phase is critical, and understanding Eric Sprott's blueprint for survival is the first step toward safeguarding your financial future. In the next part of this deep dive, we will move beyond the warning and focus intensely on the execution. We will break down exactly how Eric Sprott is positioning his own assets right now, analyzing the specific categories of mining stocks and physical metals he is accumulating. We will detail the actionable steps you must take to fortify your portfolio against this systemic collapse, ensuring that you are not just a spectator to this historic financial change, but that you are prepared to profit from the inevitable and explosive repricing of real assets that the 2026 reckoning will unleash. Get ready. This is the blueprint for survival and prosperity in a rapidly devaluing world. We have established the precipice upon which the global financial structure teeters, defined by unprecedented sovereign debt burdens and a central banking system that has lost all credibility in its ability to manage both inflation and growth simultaneously. The 2026 warning from Eric Sprott is not merely about a cyclical downturn. It is a profound structural dislocation, the moment the paper paradigm officially dies. The central failure point is the erosion of trust, and trust, once gone, cannot be legislated back into existence. We are entering a phase where the market will no longer accept promises, only proof. And proof in this context means scarcity and physical integrity. This is the fulcrum upon which the entire investment thesis now pivots. The role of physical gold and critically silver as the necessary escape mechanism. Sprott's analysis suggests that the efforts of central banks to maintain control will become increasingly desperate as 2026 approaches. They will utilize every tool in their arsenal, from yield curve control to deploying central bank digital currencies, or CBDCs. The introduction of CBDCs is not a matter of efficiency. It is a mechanism of financial control designed to track, restrict, and ultimately prevent capital flight when confidence collapses. This is why the distinction between ownership of paper assets, ETFs, futures contracts, digital claims, and physical possession of zero liability assets is paramount. When the system seizes, you need the asset in your direct control, outside the immediate reach of a failing counterparty. Let us expand on the specifics of the supply shock that Sprott has long detailed, which defines the massive upcoming revaluation of precious metals. The mainstream financial media focuses heavily on interest rate policy, treating gold and silver merely as monetary barometers. This misses the critical underlying physical reality. We are witnessing chronic underinvestment in the mining sector due to years of suppressed prices relative to inflation and geopolitical risk. It takes decades to bring a significant mine online, and the grade of ore being extracted globally is consistently declining. Put simply, the easy gold and silver have already been found and mined. This reality creates an accelerating divergence between the paper market, the COMEX and LBMA system, where derivatives and unallocated claims far exceed the physical metal and the actual physical availability. Consider silver, often overlooked but arguably the more volatile and essential component of this structural shift. Silver has dual demand drivers. It is a monetary metal, like gold, but it is also an irreplaceable industrial input, essential for solar panels, electric vehicles, and high-tech electronics. There are no viable substitutes for silver in these critical applications without significant performance degradation. This industrial demand is non-negotiable and increasing exponentially alongside the global push toward electrification. Sprott points out that the global inventories of silver above ground are dwindling precisely as industrial demand spikes. Unlike gold, which is mostly held in reserves and jewelry, silver is largely consumed in industry and cannot be economically recycled in significant quantities. The current spot price of silver is far below the all-in sustaining cost, AISC, for a large percentage of primary silver miners. They are effectively mining at a loss or surviving solely as byproducts of base metal operations. This is unsustainable. The consequence is simple. Eventually, the market will break, the supply will halt, and the price will be forced to the level necessary to incentivize new, expensive mining operations. When does this break happen? The 2026 timeline aligns perfectly with the expected geopolitical acceleration of de-dollarization and the massive maturity walls of corporate and sovereign debt. The developing world, led by the BRICS nations, is not waiting for the U.S. to fix its finances. They are systematically accumulating physical gold outside the Western financial system to create a credible collateral base for potential new currency or trade mechanisms. This physical drain on Western vaults, coupled with the inevitable inflation caused by the Fed's next necessary pivot to quantitative easing, QE, to prevent a total government shutdown, will be the catalyst for the gold and silver explosion. The pattern interrupt here is recognizing that the future price of gold and silver will not be determined by the current paper markets. The market structure itself is the target of the eventual failure. The pricing mechanism will revert to physical reality. When the ability of the bullion banks to suppress the price through derivative selling fails, likely triggered by a massive default or delivery failure in the paper market, the resulting price spike will not be linear. It will be parabolic. We are discussing not a 20% rise, but a revaluation that could see gold trade 4, 5, or even 10 times its current valuation, effectively monetizing the entire national debt by inflating the value of the only asset that holds true reserve status. This leads us directly to the climax of the warning, the Great Recalibration. The 2026 recession will change everything because it forces the political elite to confront the reality that the U.S. dollar standard, established in 1971, is finally collapsing under the weight of its own excess. When governments worldwide lose faith in the dollar as the universal store of value and medium of exchange, they need an immediate replacement for collateral and reserves. Historically and logically, that replacement is gold. Sprott's definitive conclusion is that the future monetary system, whether it is overtly backed by gold or simply uses gold as the non-confiscatable benchmark collateral, will structurally reprice the metal to reflect the true magnitude of global debt. If you view the mountain of sovereign debt that needs to be settled or backed and divide it by the total existing supply of monetary gold, the resulting price is astronomical. Those who have positioned themselves in physical precious metals will experience the largest, fastest, and most profound transfer of wealth in modern history, a transfer from creditors and debtors trapped in the fiat system to holders of sound money. This isn't just about financial prudence. It is about survival of purchasing power. During this transition, as the dollar rapidly loses its reserve status, fiat currencies will accelerate their race to zero. Inflation will become hyperinflationary, destroying savings, pensions, and fixed-income investments. Physical gold and silver act as the lifeboat, maintaining or even exponentially increasing purchasing power relative to goods and services. The key to navigating this climax is the jurisdiction and form of ownership. Sprott stresses the need to avoid counterparty risk. This means avoiding pooled, unallocated, or digital claims. True protection requires allocated, segregated physical bars and coins, stored securely in private vaults, ideally outside the immediate political jurisdiction where the worst debt crisis is occurring. If you are positioned in assets that are simultaneously liabilities on someone else's balance sheet, you have failed to heed the central warning of counterparty risk. In conclusion, the 2026 event is the inevitable convergence of monetary insolvency, physical scarcity, and geopolitical distrust. It is the moment the market forcefully rejects the decades of fiscal irresponsibility. For those invested in paper assets, it will be a period of unprecedented volatility and loss. For those who have strategically accumulated physical gold and silver, understanding the mechanics of the inevitable supply shock and monetary reset, it will represent a generational opportunity to secure wealth outside the decaying financial architecture. The shift will be violent, fast, and permanent. The time for deliberation is over. The time for action, focused on securing non-liability assets, is now.